All right, let's talk about it. How to make money in the stock market. How are you, as an investor today, going to make money in the stock market? And this applies whether you're investing in 2022, whether you're investing in the year 2023, 2024, or beyond. Maybe you get in a DeLorean and you travel back in time to the 1900s, 10s, 20s, 30s. These investing principles still work then, just like they work today. How to make money in the stock market. That's what we're going to talk about today on the Your Financial EKG live stream. And the first way that you can make money in the stock market. I'm on mute again. Check, check, check. Can you hear me? Let's go. Let's check I have got the. Can hear you well. Good. Okay. Sorry. I was making sure my microphone was working. So the first way that you can make money in the stock market is don't be greedy. First of all, thank you so much, dear, for watching. Always enjoy your comments. So don't be greedy. How do you make money in the stock market? You don't be greedy. And here's what I mean by don't be greedy. When everybody wants what you've got, give it to them. When everybody wants to give up what they've got, you take it. That's not being greedy in the stock market. Now, here's what you've got to look at. And here's what I mean in plain terms. If you want to be successful and make money in the stock market, when the market's doing what it's doing right now, so what's today? June 22nd, 2022, the S&P 500 is down 21% year to date. This is a great time. If you are planning on working for another 5, 10, 15, 20, 25 years, this is a great time for you to be looking for opportunities to continue to invest, obviously, within your 401k, your IRA, and your Roth IRA, but ways that you can increase your contributions to your 401ks, your IRAs, and your Roth IRAs. Listen, I've been looking around and I say, oh gosh, market's down 500-600 points today. Let me see what I can do. Is there extra money that I can add into my retirement accounts? Because everybody else is selling. Let me see if there's some things that I can buy. Because at 36, I've got 46, 56, 66. I've got 30 years, probably more. I'll probably never be able to fully retire doing this business. But I've got 30, 40 years of market growth. And it applies for you if you're in your 50s and 60s as well. There are ways, even when the market's going volatile, for you to repurpose your cash, repurpose into some opportunities to allow yourself to make money even when the market's going down. So the best way, the first way actually, that you can make money in the stock market is don't be greedy. Now, on the flip side, think about years like 2020 after the pandemic when the market really started to take off, or 2019 or 2021. When the market is flying high, that is the best time for you to reassess how you're invested. It's the best time for you to look at your investment accounts and go, okay, I own a lot of Apple. I own a lot of Amazon. I own a lot of Tesla. I own a lot of QQQ. These are doing really good. Maybe it's time for me to reassess my risk. Doesn't mean you sell everything and you go into AT&T stock or Kellogg's, or now they're going to be 3 different companies. But maybe you go, let's trim some off the top. Let's take some of my wins off the top and let's rebalance that into my overall portfolio. And if you don't know what rebalance is, think about it this way. If you are young like me, I'm just going to use myself as an example because it's really easy. So for me, I'm like 95% stock market growth, 5%, you could say fixed income conservative, okay? If the market is doing really well, that 95% is going to grow a lot more than my 5% fixed income conservative money, right? So I might get to like a 98, 99%, 1% allocation. What I want to do is rebalance that and get back to my 95.5, which means I sell some of my winners at the top and I rebalance that. I buy some of those funds that have not done as well at the bottom. Now, that doesn't mean you take money and you throw it into losing stocks or losing mutual funds or losing ETFs. Maybe there's some stocks or mutual funds or ETFs that it's just time to kick, but you always want to be rebalancing. So the best way for you to make money in the stock market from a principal standpoint is to not be greedy. If people are trying to get more of yours, give it to them. And if they don't want any of it, you take it a little bit. Retired 2019. Hey, Drew, YouTube did not notify you of my live stream. Hey, the reason it didn't notify you of the live stream today is because my calendar opened up. I had a couple appointments actually rescheduled for next week. And I thought, man, I'm going to jump on here and just talk to the community out there. And this was actually a podcast that I had done. The Your Financial EKG podcast. We're on Apple Podcasts and Spotify. This is an actually old podcast that I did. And I said, because of the way the market has acted for the last 6 months, let me take this podcast kind of out of the cellar and let's talk about it, because people need to know, how can I make money in the stock market even when it's going down? So let's kind of get into that. I'm thinking about doing a part-time job. Retired 2019, and part-time jobs are always great. So the first way, don't be greedy. Make sure that you give away when everybody wants it, you take some back when nobody wants it. The second way that you can make money in the stock market, especially long-term, is this: compound interest is your friend. And what do I mean by that? Compound interest, I always say this, compound interest is God's greatest gift outside of Jesus. Because when you look at your money and you look at, well, really, if you think about anything in life, you think about your money, you think about any kind of hobby or discipline that you're trying to grow, compound interest is how you get better at that, right? So with your money, compound interest is the way to grow your wealth exponentially, which means you invest $1 today, it grows to $2. Now it's growing at that $2 range, not just at $1. So you've got compound interest. You know, when I started lifting weights, one of the things that I got into in 2020, because we were locked in at home, was I got back into a weightlifting routine, basically. And I'm not jacked or anything like that, but I just kind of started lifting weights. Well, I didn't see this great, I didn't look like The Rock after 3 weeks of lifting weights. But over time, as compound interest, as compound discipline has continued to work, now 2 years in, you can really see the gains from my weightlifting. And so it's the same with your money. Now, I did actually a formula using a cash flow calculator. I wanted to show you this because I thought this would be really cool for you to see. And I'm going to test out, since you guys are patient with me, I'm going to test out my whiteboard here. So I'm going to bring my whiteboard up. I'm going to share my screen. Share screen. Window. Here we go. Share it. All right. So this is my whiteboard, so I can show you this. So I want to show you why compound interest is your friend. And we're going to put this right here. Perfect. Okay. So let's take, come here now. Oh, wrong pen. Where's my pen? Here we go. You can tell I'm an amateur. I'm not Meet Kevin or anything. This is just Drew Blackson spitballing here for you retired. So let's use this. So let's say we've got $500 a month, okay? And we're going to invest that for the next 30 years, and we're going to earn 6% on that $500 every time we invest it, right? So remember, the market has averaged 10%. So the S&P 500 has averaged 10% since 1956, 57, somewhere around there, whenever it came into existence. It's 8% with inflation. So I'm going to back off by 2%. If you've watched any of my videos, I'm very conservative. So I'm going to back off by 2%. And I'm going to say we average 6% on $500 a month over 30 years. If you do that, if you just put in $500 a month at 6% for 30 years, you would have what is the number? $268. $505,268 at the end of that 30 years. So if you're 20 or 30, $500 a month, that should be your goal. Let's get that into a 401k, an IRA, a Roth IRA. Think about if you're putting this into a Roth IRA, $500,000 tax-free. That's awesome. But here's the thing you got to think about when it comes to compound interest. You put in $500 every month for 30 years. How much did you actually invest? You invested $180,000 over that 30 years. So you put in $180,000 and it grew to $505,000 because of compound interest. So if you want to get rich, not get rich, but if you want to make money in the stock, I hate to say that. People are always like, I want to get rich in the stock market. Well, it's consistency. The people that get, Warren Buffett's net worth has increased more after the age of 70 than it did in his entire life. And so a lot of times if you're thinking, oh man, I want to grow my wealth exponentially in the stock market, it's consistency. It's doing the same thing over and over, year over year, and staying the discipline is a tough word because I played sports. So it was always about discipline and, hanging in at the plate, making sure you continue to do what you're doing. So you want to I would just say, continue doing what you're doing, save, contribute, and invest. Now, let's look at this. If you take out this $500, so take out the 500 here. Let's add into that. We're going to take out the 500. We're going to take out this. And we're going to take out the investment here. Same figure, but now instead of $500 a month, we're going to do $1,000 a month. Okay, so now we're putting in $1,000 a month for 30 years at 6%. At the end of that 30 years, we're going to have $1,010,537. And what did you invest? $360,000. And you grew it $700,000. Isn't that crazy? Compound interest is God's greatest gift outside of Jesus. And if you want to make money in the stock market, it's about consistency. And people say, well, Drew, it's about the stocks you buy. It's about the mutual funds you buy. It's about the investments. It's about making sure that you're watching Power Lunch or making sure that you're watching CNBC and Fox Business and getting all the latest picks and the right stocks and the hot crypto. No, it's just being consistent. It's being really boring and consistent. Jack Bogle, the founder of Vanguard, is one of my I would say somebody that I have read a lot of his books, really enjoy. He's deceased now, and I wish I had an opportunity to speak with him. But he's somebody that I kind of look at in the financial space to say, okay, this is how we can do things. And it's really, if you think about Vanguard, you think about, you obviously mutual funds, 401ks are kind of the thing that come to mind, but you think, okay, this is really boring, right? So like mutual funds are super boring. Investing in mutual funds sometimes can be super boring. And I don't mean boring like yawn, you don't make any money, but I mean, there's not like this excitement to it. It's not like I asked a question on Facebook last week on our Pearl Wealth Group Facebook page. If you haven't seen that, in the descriptions, our Facebook page, you can go on there, like us, follow us. But I asked a question on our Facebook page and I said, what was the very first stock or ETF or mutual fund that you bought? And maybe that's you too. Let me ask you this in the comments. What is the very first stock, mutual fund, or ETF that you bought? So for me, it was Domino's Pizza. Okay. So I was 20, I don't remember how old I was. I was like 22, 23 years old. And I bought Domino's Pizza. It's the very first stock I bought. I bought it for $25 a share. This was 2009, right after the crash, because that's when I had graduated. And Domino's Pizza went from $25 a share to $50 a share. And I thought I was killing it. And I didn't own a whole lot of it, right? I think I owned like 100 shares or something. Maybe, I think I actually owned less than 100 shares. I was a broke college kid. We've been drinking beer and eating pizza and playing baseball for 4 years. So, I don't remember how many shares I had, but I went from $25 to $50 a share by owning Domino's Pizza. And I thought, man, I doubled my money. And I looked around, I looked at Yum Brands and I looked at Papa John. I looked at these other, I looked at some of the other pizza companies and food companies. I said, I'm going to sell. I doubled my money. And so I sold Domino's Pizza at $50 a share, went from 25 to 50. Now, if you want a good laugh, look up the ticker symbol DPZ today. Domino's Pizza, okay, DPZ, and you'll see where it's trading at right now. So I probably shouldn't have sold if you actually look at the stock price today. But what I mean by that is it's not necessarily saying what's this hot stock. It's just making sure that you're investing your money into sectors, into stocks, into ETF. I mean, we use ETFs in the portfolios that we manage. We want to invest in things that are going to fit what you are trying to accomplish with your investing. So again, I'm 36. My investing portfolio is trying to hit home runs, right? My dad's 67. He's not trying to hit home runs. He's trying to get on base, singles, doubles, be more consistent. Let me get a couple of these in here. Aider guy, shoot a deer. No, man, I got to get you a better ticker symbol, or at least tell me your first name so I can remember that. Home Depot stocked when you worked there in college. Stock went from 60 to 18. I told everyone to buy it. I had 100 shares, sold a third share, buy a truck. What a mistake. Hey, look, Home Depot done incredible. Kyle Morgan, let's look at Kyle. Nokia, a long time ago, not a great choice around 2000, but we learn from our mistakes, right? In investing, you learn from your mistakes. When you run a business, if you run a small business or any kind of business, I was listening to kind of this business guy the other day, and he said, or not, he didn't say Drew, it was on a podcast, but he said, when you get a yes, you celebrate. So when somebody hires me to be their financial advisor or to do a financial EKG form, I say, yes, I'm excited. I celebrate that. But when they say no, you learn from it. And so, Kyle, it's the same thing for you. You know, when you buy a stock and it doesn't do as well as you think it's going to do, you learn from that mistake. And that's exactly what we have to do investing. Because if you go down to the water cooler, right, and talk to your friends, what are they going to talk about? All their wins, like how they made all this money. It's like you go to the horse. I don't go to the horse track. I don't gamble. But like my friends who do gamble, like who bet on NBA games or whatever, they only tell me about their wins. They never say, well, I put this money on this team and they didn't cover the spread. They only talk about them winning. So it's the same thing with your retirement investing. It's the same thing with any kind of investing. Just make sure that you're invested into funds or stocks or ETFs or whatever that's fit for what you're trying to accomplish. So again, think about it like a baseball example. So again, 36, Kyle, I see you're 34. You know, think about it in the sense of like, if you've got 20, 30, 40 years before you retire, you can really take advantage of like today's market. Now you can't see what I'm pointing at, but I'm pointing at a TV with CNBC on it. But you can take advantage of moments like this when the market's down and be buying at these low levels, looking at your couch cushions, looking at your budget and saying, okay, is there extra dollars that I can add to my 401k, to my IRA, to my brokerage account? If you're already maxing out your IRA, you know, you can put money into, a lot of people don't know this. If you have an IRA or a Roth IRA or a 401k and you're maxing those out, you can also invest in a brokerage account, just a regular investing account. Now, there's no tax benefit to that. You don't get any kind of like deferral of income. If you do that, it's not tax free when it comes out, but you can take extra money and invest it into the market. And you just pay taxes on the capital gains and the interest, and you get, you know, you write off the capital losses if you don't win. So if you've got time, now is a great time to be investing. Now let's talk about if you don't have as much time. So my dad's 67. Let's talk about some of the people that I talk about on the channel, especially those who are in their 50s, right? I do a lot of retirement planning at age 50, retirement planning at 55. And you're looking at this market. I think I just saw a comment on here. Here we go. Retired 2019. Being retired, I'm a little concerned about market volatility, still doing 4% withdrawal, which is great. A lot of people are concerned about stock market volatility. And if you are already retired, meaning you're not getting a paycheck anymore, you're living on Social Security, or maybe you're not to Social Security yet, you're living on your retirement investments. If you're wanting to make money in the stock market, now it doesn't become this scenario where you're saying, okay, how much can I make? The question is, how much can I preserve, right? How long is this going to last? I ask everybody who sits down with me, and we do it virtually via Zoom. I ask this question. I would say, what's more important to you, growth or protection? And a lot of times people say, well, I want both. And I'll say, well, no. Let me ask you this. What's more important to you, growth or protection? Because if you're in your 50s or 60s and working and you haven't retired yet, it's really time to start thinking about this transition protection, to trying to protect our overall assets. Because again, I'm 36. I've got 30 years to try to hit home runs. My dad's 67. His time horizon for investing has shrunk. Now, he'll probably work until the day he dies. That's because that's who he is, and he put that in me. But his time horizon to make up, right, his IRAs, his 401ks, he's got to start taking a required minimum distribution out of that in about 5 years. And so his time horizon has shortened. And so instead of trying to hit home runs now, he has transitioned his investments to more conservative, more protection. And listen, if he makes 4 or 5% a year for the rest of his life, he'll be happy because he knows that that money is protected, or that money is as protected as he possibly can in the market. And so right now, Obviously, this is not a time where I would be telling you to sell what you're in, to rebalance your portfolios in the sense of getting out of something and getting into something new. Right now is a moment where you really need to look at your portfolio and say, how do I feel about the risk that I'm taking? How do I feel about these losses that I've incurred? If you feel great about them, then good, stay where you're at. But if you're older, if you're in your 50s and your 60s, and these losses and this makes it kind of stomach churning for you every time you look at the overall market, this is a time when you need to really think, okay, when this market comes back, I need to make some adjustments to what we are doing. Hey, CJ. Hey, Chris. Thanks for the comment. Yeah, we did talk a little bit about love your email and newsletters. Hey, thanks for signing up for the newsletter. If you want to if you want to get signed up for the newsletter, go to my website. I think it's on Your Financial EKG or pearlwealthgroup.com. At the bottom, it says sign up for the newsletter. And you can do that when we get on that newsletter. We send out a newsletter once a week talking about the markets, talking about where things are at, kind of just my thoughts on the economy, fun statistics, and just kind of, I try to keep it light, just like I do on the YouTube channel. So the second thing, compound. So first is don't be greedy. Want to make money in the stock market? Don't be greedy. Second thing, compound interest is your friend. Continue to contribute, invest, or continue to save, contribute, and invest. And the third thing kind of goes with what we were just talking about. Remember your purpose. Remember why you are investing. Weester in, new to the YouTube channel. Think about retiring at 55, love watching YouTube. Hey, this is a great comment. Thanks for watching the channel. I'm 50, thinking about retiring at 55. Love watching your YouTube about retiring at 55. Hey, thank you so much. I appreciate that. Really enjoy the kind words, Weester. So remember your purpose when it comes to investing. If you watch my channel enough, you know that I'm kind of a guy of faith, and I love a scripture. Proverbs 1:19 says this. It says, "Such is the fate of all who are greedy; it robs them of life." And it's not necessarily greedy in the sense of like, I need more and more money. But when you think about your investing, think about what your purpose is. What are you trying to accomplish? At what point is enough money enough money? At what point in your investing life do you get it and you go, oh my gosh, I've got enough to live the rest of my life? So you always want to remember I just had a conversation with a gentleman recently, and he was taking way too much risk at his age. And because of what the market has done, he's lost over 50% of his retirement investments. And I think as we were talking, he was kind of saying, listen, I kind of got caught up in all this. Now, he owns a lot of great stuff, and we're not going to sell because that doesn't make sense at this point. But we really want to remember our purpose on why we're trying to invest. Why are you trying to invest? Why are you investing for retirement? It's to get to retirement. And then once you get to that figure, once you get to that point where I'm like, okay, this is enough for me, that's when you can start doing this planning and say, okay, I really don't want to lose now that I've got this money saved. So think about this. Remember your purpose. If you're looking to get rich quick in the stock market, stop. It's not going to work. It's not going to work. So how to make money in the stock market? Don't be greedy. Compound interest is your friend, and remember your purpose. So I want to show you guys some real world stuff here. Let me see if I can pull it up. Let's see. If you have any questions, leave them in the comments. Love to answer the questions on here. We're going to do 30 minutes. It's been about 23 minutes so far. So we're going to do about 7 more minutes because then I have a date at 3:30 with two girls and my youngest son. So 2 girls, my 2 daughters, not 2 girls. I'm married. 2 girls, my daughter. Probably going to go to the pool. But let me pull up something I want to show you. Here's a question as well. Put that over there. So Weester, great question here. My retirement investment has been down over 25%. Just wondering if I should move all that money to market fund. And I'm assuming you're saying money market fund. I don't, at this point, don't make any changes. And again, listen, past performance is not a guarantee of future results. Make sure you consult your financial advisor, investment advisor, CPA before taking any action. But let's say we just met at Starbucks, right? And you're like, hey, what do you do for a living? I'm a financial advisor. Hey, I'm down 25%. Should I move all that to a money market fund? I would hesitate on that. Weester, you said you're 50, thinking about retiring at 55. You got 5 years. So you've got some time for the market to really recover. So the average bear market is about 14 months, right? 14 months? Yeah, 14 months. And so we're in a bear market. So let's say we're in this for 14 months. Well, you're going to come out of it eventually, right? You're going to come out of it before you retire. And so the market gains that you're going to get coming out of the bear market are going to supersede any of the losses that you've incurred going into the bear market. I have this great picture I should show you guys. Let's see if I can find it here. This is a bull versus bear market chart, and you might have seen this. Let me share this screen. 1 second. Share screen. Here we go. Bull versus bear. Share this. Look at this. This is kind of, what is this? 1926 to 2016. So it's not necessarily super updated, but think about the bear markets that we had. There's the Great Depression. Here is, another 22% down. Here's 22% down in the 60s. 29 in the 70s. Here's 43%, 76 when we started to get high inflation. But look, here's what I want you to think about. Here's 2000. Here's the tech bubble, and here's the 2008 financial crisis. Look what the market did coming out of these bear markets. Now, obviously, 2008, we know what happened all the way to 2022, basically. So what the problem is we're in the middle of this right here. Like, we're in the middle of one of these downturns, and we just don't know when this upturn is going to come. What you don't want to do is you don't want to get out here and then try to get back in right here, because you don't know. You don't. So when the 2008 crisis happened, we had what they call a bear market rally. And what a bear market rally is that the market has fallen 20% and it tries to rally, means it tries to go up off that 20% low. And the market went up about 7%, if memory serves me, and then went right back down. And so you want to always stay invested, especially if you're a long-term investor. And I would say long-term is 5 to 10 years. So anytime after 5 years, you're looking more longer term. I would hesitate on selling anything right here, especially if you're a longer term, 5 years or more investor. Another great statistic that I read the other day in Barron's magazine, and it said that out of 52 weeks in a year for trading, right? There's 52 weeks in a year. We have 52 trading weeks in a year. There are 10 days in those 52 weeks that will determine the total gain or loss for the stock market. Meaning, if you miss one of those days, you're going to miss the big up or you're going to miss the big down. And so if you are invested in the stock market, the best thing that you can do is to stay invested in the stock market. And it goes back to what we were just talking about. If you are younger, if you're in your 20s, if you're in your 30s, if you're in your 40s, and you've got extra cash laying around, this is a great time to be looking at reinvesting some of that money into the market to try to get buy the S&P 500, right? Buy, a mutual fund or ETF that's just the S&P 500. It's down 21%. And you can't tell me that the S&P 500 is not going to recover. You might say, listen, I'm going to buy some Apple stock. I'm going to buy some Tesla stock. I'm going to buy Amazon. Those are down. That's great. I hope you buy it. I hope it goes up. I hope you make millions doing it. But I can't promise you that individual stocks are going to go up. But I can pretty much look back at history and say, if you own the S&P 500, if you own, you could buy a total market fund. You could buy a QQQ even. Obviously, it's a little bit more volatile because it's the NASDAQ. But you could own these ETFs or mutual funds, and over your lifetime, you're going to make a lot of money as long as you continue to save, invest, and contribute. Well, save, contribute, and invest. I keep doing it backwards. Save, contribute, and invest, and make sure that you're looking at your investments. One of the things that I did, if you saw a recent video, I did for a client. It was a 60-year-old. He wanted me to do a retirement investment analysis for him. It's the very first video I've ever done on YouTube with a retirement investment. And the reason I hesitate getting on here to talk about investing or the stock market, there's a lot of talking heads on YouTube. You probably see them on your homepage. If you watch my videos, you get recommended videos. You see them on there talking about, they do market closes. They tell you what stocks to buy. They tell you what cryptocurrency books to read. I hesitate talking about that because I don't want to, as first of all, licensed with as an investment advisor representative and licensed with FINRA and all that. I hesitate talking about things that you know, I just don't want to get you guys in trouble. I have a great responsibility for the education I give you. But I did a video, retirement investment. And one of the things that pointed out, I tell you what, let me just pull it up. That would be better for you guys. This is the last thing I'll do for you. Let me pull this up and then I'm going to get out of here. Where are we at here? Perfect. So you want to look at your portfolios, and let me show you some things that you want to look at. If you're wanting to make money in the stock market, let me show you some things that you want to be analyzing inside of your portfolio. And again, if you have any questions, leave those in the comments and I will get to it. Okay, share. Come on. All right, so here's what I want to show you. So this is a portfolio for a financial planning client of mine. So listen, if you're someone who self-manages and you want me to do a financial plan for you, a financial EKG, we do what we call an investment management service as well on that if you want. And that's where I look at your investments that you own and we kind of dissect those. And I say, okay, what are the fees? What's the performance? How's it done? We're going to look at it. So in this case, we're looking at this portfolio and I want to show you what I look at so that you can look at it. Now, this gentleman, he owns all his money's all Fidelity. Now, he does it himself. There's no investment advisor. And as you can see, he owns mainly Fidelity funds and then a few stocks, General Motors, AT&T, and then the spinoff Warner Brothers from AT&T. So I look at this and I say, okay, why? First of all, the question is, I see, especially if I see like all American funds or all Vanguard funds or all Fidelity or all, I always ask, why do you own all of the same fund? Like, why do you own only Fidelity funds? And his answer to me was, well, I'm at Fidelity and I just thought these are the ones I should buy since I'm at Fidelity. And so my question back was, and again, I'm not trying to be a smart aleck. I just ask questions. And I said, does Fidelity, do they have the best funds? Are all their funds like the best funds that fit you? Like they're the best in the world that fit you? And he was like, well, no, I just didn't know if I could invest in anything else. And I said, yeah, you can. So let's look at this. So he owns all these Fidelity funds. So that was the first thing. I want to know, hey, why do you own all these Fidelity funds? And again, I'm not trying to be down on this gentleman. I just want to say, hey, what have you got and why do you have it? The first thing I always look at when I'm looking at anybody's portfolio is I look at expense ratios. Now, my program that I use is more for an investment advisors. It's easier for me to kind of get all these in one place and get a total expense ratio, but you can do this on your own. Just look up each mutual fund you have, go to Yahoo Finance. You can find the expense ratio for the funds that you own. But I want to look at the expenses. So on this portfolio, it's a $492,000 portfolio. His expense ratio is 0.59. Now, if you don't know what expense ratio is, if you own a mutual fund or an ETF, there is a fee to own that mutual fund or ETF. They call that an expense ratio, and that's paid out to the mutual fund company or to the ETF company. So for this guy, he has a fund, FMCSX, that charges 0.83% a year for him to own it, all the way down to FSSNX, which charges 0.03. So if you think about it, on this one, right, this fund right here, where's it at here? Expense, there we go. His net expense ratio is 0.83. So what that means is on this fund, what is this, Fidelity Mid Cap Stock Fund, before he gets out of bed on January 1st, 2023, he's already going to be down 0.83 because that's the fee to own the fund, right? It's the expense ratio. So my question when I started going through this with him, and if you've watched the video, you've seen me, I said, why do you own this high expense fund? He goes, well, I wanted exposure to the mid caps. And I said, well, what if you had exposure to the mid caps and you did it like really conservatively? And so one of the things that I was showing him was, and again, I'm not trying to tell you tell you guys what to do, but let me go to, this is one of our portfolios. I think is it VO? Yeah. So here's the Vanguard Mid Cap ETF. Now, again, two different kinds of funds. One's a more actively managed mid cap fund. This is a mid cap index fund. But the mid cap index fund, the expense ratio is 0.04. And I'll bet you the returns, maybe in a year like this, might be a little different. But if you get long term on the returns, they're not going to be that much different. And so if you're going to hold something over a long time frame, man, you want to make sure these expense ratios are low. You want to make sure that you're not paying too much in expenses. And for him, think about it in real dollars, right? So I can say, oh, it's 0.60%, 0.6%. It doesn't sound like a whole lot. On $492,000, that's $2,912 a year he's paying in fees. And for him, he doesn't want a financial advisor, an investment advisor managing this, because he doesn't want to pay a fee for his investments, which is fine. You know, we have clients that I work with that we manage their accounts. They pay me a fee to do that. He doesn't want that, but he's essentially paying a fee because the funds that he owns are charging this high expense ratio. So we got to look at that and ask ourselves, does this make sense for us? Now, the second thing I always like to look at is income. You know, how much income is coming off of this portfolio? Again, it doesn't matter where you're at, whether you're 36 like me or whether you're 63. I just want to know, you know, how much yield are you getting on the portfolio? For him, this is more of a growth style portfolio, so his yield's 1.24. That's fine. He's getting a little bit of income. Let's look at risk. When we think about risk, you know, how is his portfolio? What's the risk on this in the event of market downturns? And so what I'm able to do is look back and say, oh, in the tech bubble, you would have lost 8%. In the quarter 18 sell-off, you would have lost 16%. That's the last time the Fed raised rates before now. And then COVID, you lost 26%. So, you know, when you're looking at this, I go, okay, how do you feel about your risk? It's a growth portfolio. Okay, I feel pretty comfortable. So those are kind of some things some of the first things that I look at. I'm getting excited. I'm getting a little ahead of myself. So now we're going to talk about performance. And this is where the rubber meets the road a little bit. And Kyle, let me show your comment real quick. In your opinion, what is an acceptable fee percentage on a mutual fund? You know, I've heard it said that 0.5% and lower, so 0.50 is the highest you'd want to go on a mutual fund. Listen, so for me and my clients, for me personally, you know, with what I invest in, I only use index funds. Okay. Now, again, I don't want to get into theories, or I don't want to get into right and wrong, because that's just what I do. But I only use index funds when it comes to the investing for my clients and the investing for me. And so those fees on index funds are like, I think the highest is 0.09. So 0.9%. So I would say if you're investing, and Kyle, you're younger. So if you're investing for the long term, I would say owning ETFs that are built for growth, that are indexed, are going to be a lot more beneficial for you over the long term with lower fees than trying to be in actively managed ETFs. And when I say actively managed, think about like ARK. You know, they have actively managed ETFs. Again, I'm not against Kathy Wood. I'm not against ARK. I'm just saying that's actively managed. You see how good they did last year. You see how bad they're doing this year. Those are actively managed ETFs. So you want to, I would say if you're younger, 30s, 40s, even 50s and 60s, it would be hard for me to say anything over 0.10 is a reasonable fee. I think there's other alternatives out there. I think we've got into this price war when it comes to ETFs or mutual funds. If you, with Charles Schwab, Fidelity, Vanguard, BlackRock, you know, there's all these different companies. If you're in a fund that's an index fund or it's an actively managed fund and your fee is like this, I would have a hard time justifying that as an advisor. Okay. Saying that's where I'd go. So I would want to see more like this. So what is FSSNX? I don't even know what the fund is here in this guy's portfolio. That's the Fidelity Small Cap Index. So there's his small cap exposure, and look at the fee. You see how the difference, like mid cap actively managed 0.83, small cap index 0.03. So I would prefer that, Kyle, to answer your question. I hope that helps. So now let's look at performance. So the last thing I always look at, especially when I'm analyzing somebody's investment portfolio, is I want to look at performance. So this is a great year to look at performance because the market's really stunk. And so we can really get a good gauge on how someone's investments are performing in a bad environment. And you know, so we have hurricanes down here in Florida. And I don't know if you've ever experienced a hurricane, but it's pretty nerve-wracking in the sense of like, it's kind of like this slow crawl. Like when I lived in Kentucky growing up, I lived 18 years in Kentucky from birth to 18 before I moved to Florida. We had tornadoes. And like tornadoes are those things where like dad would run in, wake up, there's a tornado, we got to go to the basement. So tornadoes kind of like, boom, it's here, you got to go, right? With hurricanes, it's like, okay, it's in the Caribbean or it's coming off of Africa. And you're like, it's coming, right? And so you're like trying to prepare for this. You're like, I got to buy my water. Do I have enough gas in the generator? Do I have extra gas? Are we going to need to drive to Georgia? Are we going to need to like, what are we going to do? And so when the hurricane hits, that's the last time, like that's the worst time to try to prepare for it, right? I've been to Publix, I've gone to Walmart, I've gone to the gas station like the day before the hurricane hits. And it looked like when it was in COVID, like the shelves are empty. The gas has the little yellow bags on it. And so when the market's going down, this is like, I think this is it's actually the worst time to make adjustments to your portfolio. Cause like, you don't want to sell off so low, but it's the best time to compare how prepared I am for the next one. Okay. Because you go through one hurricane and you lose power, and you're not prepared for it, you'll never do that ever again. You'll always be prepared. And I'm really, I'm always prepared for hurricanes. I always have that extra water and extra gas. So think about performance. So here's the performance. Over 1 year, this guy's portfolio is down 16.45%. Year to date, it's down 19.18%. And over 3 years, it's up actually 5%. So you say, hey, Drew, so what? He's down 19%. Let's compare that to an index. Let's compare that to the S&P 500. Well, the S&P 500 is down 20.43% over the same time horizon. So I say, okay, same time horizon, you're down with the S&P 500. It's a growth portfolio. That makes a lot of sense. Over 1 year, now here's where it starts to get a little like, we need to talk about this. Over the last year, he's down 16.45. The S&P's down 9.59 or 9.6%. Something's going on here, right? Because now the S&P is actually lost less than his portfolio. So when I see this, when I see that the market is actually lost less than his, I automatically think, okay, he probably is going to make a lot more money on the upside because he's more risky, right? So he's down 16%, the market's down 9.6. You would automatically assume in your mind, he's probably more risky, right? He's more growth oriented. So let's look at it. We look at a 3-year chart. Uh-oh, what's going on? Market's averaging 10% a year over 3 years. His portfolio is only averaging 5. Over 5 years, the market's averaging 11 and he's only averaging 5.42. There's this large gap in his retirement investings. Now, listen, on the downside, he's taking it with the S&P 500. He's going down with the S&P, but on the upside, he's not keeping up with it. He's not correlated to it. So you're correlated. He's correlated. What I mean by correlated is he's moving 1-in-1 with the S&P 500 on the way down. He's moving correlated with the S&P as the market's going down. But when the market goes up, there's this like gap. And so when I got to talk to Joe, I said, hey, Joe, do you see this? So there's something going on in your portfolio, or something's changed in the market environment, or something's changed in how you invest to where you're experiencing the down moves of the market, but you're not getting it on the upside. And so that's really what you want to look at. And you want to compare yourself to whatever index fits you better. So if you're younger, look at the S&P 500. If you're older, you look at the S&P 500, you look at some of maybe the Morningstar Bond Index or something like that, just to kind of see where you're at. Okay, so I hope this has helped. Let me stop the screen share real quick here. I hope that's helped. Let's see this question from Weister. Let's see, great question. If I've maxed out all the retirement and I have extra cash, should I invest in I-bonds since it has over 9%? I-bonds are great. I mean, listen, it's 9.62%. You can put $10,000 in a year. That 9.62 for an I-bond is guaranteed for 6 months. After 6 months, I think it's October-ish, they redo the interest rate on the I-bond. You have to leave it in there for 1 year. So if you're going to put money into an I-bond, know that it's going to be gone for 1 year and you're going to get that interest. But yes, treasurydirect.gov is where you get I-bonds. You can do it electronically. If you've got some extra cash, that's a great place to put it. Plus, I-bonds are backed by the full faith and credit of the United States government. So you don't have a lot of investments. You might laugh at that, right? But again, it's the full faith and credit of the United States government is the safest investment in the world. And so, yes, if you have some extra money, an I-bond is a great place to go. Okay, so how to make money in the stock market. Remember, don't be greedy. Compound interest is your friend, and remember your purpose. Any other questions? I'll hang on here for like 2 more minutes to see. I've gone like 15 minutes over. So you get me excited. I went 15 minutes over what I said I was going to do. I was going to do 30 minutes. I'm at the 45:27 mark. Let me see if I want to show you this. This might be a good one to show you guys. Market swings. Hey, this is actually a pretty good. I'll show you this chart while I'm waiting to see if there's any questions. Where are we at here? Market swings. Take a look at this. So this is like if you invested $10,000 back here in 1940, right? Japan attacks Pearl Harbor. We've got the oil crisis. Fed funds rate raised to 20%. Berlin Wall comes down. Black Monday. 9/11, dot-com crash. I mean, all this different stuff. Look at where your 10,000 has grown to. And now, obviously, this is a long time frame, right? 1940 to 2020. But the point is that the market, right, is still, I mean, the problem is where we're at right now in the market, it's like right here, right? Like we're going down. And we don't know when that floor for the stock market is going to be created. What's the S&P today? Dow's up 100. I just lost my ticker symbol. But, you know, if you think we're trying to figure out where that floor is for the market, where we're going to start to come back up. And so, you know, it's hard to say, oh, my gosh, I want to stay in because I'm getting creamed. But if you look at it over the long term, I mean, this goes back to I can't remember whose question it was. This goes back to whoever was asking about a 5-year retirement. Look at this over 5 years. There's still a lot of money to be made in the market. So you don't necessarily want to get out just because you're going to retire in 5 to 7 years. Doesn't make sense at where the market is at this point. Let's look at, I got a couple questions here. What do you unit about tips versus, what do you think about tip? Okay, here we go. What do you think about tips versus I-bonds? So Treasury inflated protected securities versus I-bonds. So I-bonds are a little bit more limited than tips are. Tips you can buy in ETF form and mutual fund form. That's how we buy them for our clients. We use ETFs. I-bonds are set based on the consumer price index. They're set based on inflation. You can only use $10,000. So tips are more of a long-term investment because you're looking at, I'm trying to protect these treasury investments over a long term, more of a conservative long-term approach. Whereas an I-bond, you're really just saying like, I'm trying to sock away 10 grand that I'm not going to need for a year. It's kind of like when a bank offers a really high CD rate. So you get into that really high CD rate for that time frame, and then you pull all your money out, right? So with an I-bond, it's kind of the same way. So I would say depending on you know, tips versus I-bonds, tips would be more in your portfolio, like if you're investing, whereas an I-bond would kind of be like outside cash. Are you doing Roth conversions right now for clients? I still need your first name, dear guy. Are you doing Roth conversions for clients right now? Yeah, this is a great time to be doing Roth conversions. When the market is down, like right here and right here, this is a great time. Kevin, perfect. All right, Kevin, I'll remember that too. Kevin, this is a great time to be doing Roth conversions because what's happening basically is you're able to convert at a low level, right? You own the same amount of shares that you owned when the market was here. Like you own 100 shares here and the market comes down, you own 100 shares here. But now you can convert those 100 shares at a lower level. And then when you do that conversion, as the market comes back up, your 100 shares will appreciate in price. You've paid lower taxes on it over here, and it's appreciated in price. So you actually, your investment's worth more because you've done a Roth conversion at a lower level. You know, I would recommend, I mean, I do Roth conversions in any kind of environments, but when the market's low, so personally, when the market's doing, I did a Roth conversion back in like February because I was like, oh man, the market got killed. This is a great, and I did it at the 10% level when the market was only down 10%. And I'm actually looking at saying, okay, does it make sense for me to do more now? But yes, we're doing it for clients as well at this point too. So Kevin, great question. Thank you for that. All right. Hey, thank you so much for watching. Make sure you subscribe to the channel. If you want to talk to me ever, go to yourfinancialekg.com, download the free roadmap to retirement. It's on there. There's also a box if you want to meet with me. Would love to talk to you to help you in your financial planning. Have a great day, guys. God bless. Bye-bye.